Yes, my people, hope you are well. This is Ground Zero, brand new series where we're pretty much bringing it back to the basics and actually teaching you what the Forex market is, and just the fundamentals behind it. Because a lot of people go into the market looking for a strategy, looking for a model to trade, looking for this, looking for that, but don't actually find out what the fuck the Forex market is. And this is what this is for, to fill that gap in a lot of people's knowledge, to understand the actual markets. So episode 1, introduction to the market. So there's 4 main questions I'm going over today. It's what is the Forex market? Who are the market participants? What are you trading in Forex? And what are the 2 types of analysis? Let's just get straight into it. So the 4 main market participants, or the 4 market participants, are big banks, hedge funds and institutions, retail traders, and tourists and businesses. Obviously, when we talk about big banks, we talk about JP Morgan, Goldman Sachs, Deutsche Bank. They trade billions daily. They are called market makers because they help set currency prices based on supply and demand. Hedge funds and institutions, and these are obviously your big firms that a lot of people, a lot of you guys probably might, or your family members might have investments in hedge funds, but they will be trading the markets with advanced trading strategies like HFTs, because they can pretty much capitalize on very small movements because they have so much funds. And that's why we always say, in terms of trading, it's not about how much money you can, or how much percent you can make, it's about how much money you actually have, because the more money you have, the easier it is to make money. And that is how hedge funds and institutions actually do very well in these markets. Number 3, retail traders. So retail traders, these are us. It doesn't matter if you think, oh, he's a retail trader, this and that. Everyone is a fucking retail trader who is trading less than, say, like, probably, I'm not too sure what the figure is, but if you're trading anything less than, say, 100 grand, or even less than that, really, anything less than sort of $1 million, you're still a retail trader. Maybe even higher, really. But yeah, we're all retail traders. Everyday people like you who trade Forex from their computers or phones, thanks to online brokers, obviously that is available for us. So people like Pepperstone, Braze Markets, FX Pro, or whoever you want to pick, right? All these people, all these brokers, sorry, have opened up to retail traders, which has allowed us to actually trade the markets. Tourists and businesses, and people for some reason forget this so much. I don't understand why. When you exchange money for a vacation, you're technically trading Forex. Businesses that operate globally also need to exchange currencies regularly. For example, a US company buying goods from Japan must convert USD to JPY to complete the purchase. And when that purchase happens, so when the USD is converted to JPY, to the Japanese yen, the demand for the yen goes up. That's what increases the yen value. So for example, if you've got a lot of people from America going to Japan, for example, at a certain time of year, let's just say August for an example, you're going to see the demand for the Japanese yen go up, where you're going to see the yen obviously appreciate maybe more than the dollar. And what are we actually trading in Forex? When you trade Forex, you're not buying physical money, obviously, like stacks of cash. Instead, you're trading exchange rates between 2 currencies. Think of it as a seesaw. When one currency goes up, the other must go down. Currencies are always traded in pairs because you're exchanging one for another. And that's obviously how you get that increment between. For example, EUR USD, which is Euro versus the US dollar, GBP JPY, which is the pound versus the yen, the USD CAD is US dollar to obviously the Canadian dollar. When you trade Forex, you're betting on whether one currency will rise or fall against the other. If you buy Euro USD, you think the Euro will go stronger against the dollar, and obviously vice versa. If you sell Euro USD, you think the Euro will go weaker and the dollar will win the tug of war. Again, a lot of people like sort of misinterpret this, and I think this is when you bring it back to basics, and it really does help you understand what you are doing in the markets, because a lot of people think it's right, it's the chart, whatever happens on the chart is the reason why price move. It's not. So if we can see the strength of a currency over another strength of a currency, say if we've got a weak euro and a strong pound, a strong dollar, then we know we're going to be going for shorts on the EU, okay? And if we can find that market narrative, we are laughing. But what are you actually buying? You're not physically holding euros or dollars in your hand. Instead, you're buying a contract that represents their value. It's like saying, I believe this exchange rate will go up or down. So it's pretty much like a bet. Why do prices change? Currencies move because of news, politics, economic data, and even rumours. For example, if the US economy is booming, the US dollar gets stronger. If Japan announces low interest rates, the Japanese yen might weaken. If a major event like an election or war happens, currency values can swing wildly, especially where the war is. For example, the Russia or Ukraine at the moment. their currencies were going crazy, and then that's when you see safe havens start to boom, like gold, safe haven currencies like US dollar. The goal: profit from price changes. Your mission in forex trading is simply buy low, sell high, or vice versa. If you buy Euro USD at 1.1 and sell at 1.12, you make money. If it goes the wrong way, you lose money. Simple as that. Simple as that. What are the two types of analysis in trading? And this is the thing, boys. The reason why I want to go over this in the video is because you need to understand that you can't just be getting profitability over technical analysis. It's just one way, or it's probably possible, right? But it's so difficult. And again, this makes it trading so much easier than just trying to go for technical analysis. Technical analysis is like reading a chart to predict the future of prices. Instead of looking at news or the economy, traders study past price movements, trends and patterns to guess where the market will go next. Fundamental analysis. So this is what a lot of people do tend to miss, but I do influence you to heavily have a look at. And we go over this. We have a series in the 2024 mentoring, I believe. I think it's in 20. I think it is. It was like the end of the year we did it. Fundamental analysis is like checking a country's report card to see if its value will go up or down. Traders look at economic data, news, financial health to predict price movements. For example, forex traders watch interest rates, inflation, and GDP. There's a few more, obviously, we look at, but there's just a few examples. And that is pretty much what I wanted to go over in this basic video of answering these 4 questions here, which again, answering these really do actually make you understand what the market is about. But yeah, I appreciate that for you boys. The next video is going to be on trade executions, and we're going to get into a little bit more of the advanced stuff. But I appreciate you, man, for watching. I'll see you, man, on episode 2. Sweet.